In another 15 seconds or so, we'll be going live, please. We are live now.
Good afternoon and welcome to this very interesting session on D&O and IPO Risks, the imperative for independent directors. I take this opportunity to welcome Nilesh Shah, a very popular and esteemed guest today. Nilesh is the chairman of the CII National Committee on Financial Markets and also the group president and managing director of Kotak Asset Management Company Limited. This subject that we have taken up today for discussion is an interesting subject because when we talk about IPO, when we talk about public, the initial public offering, though it presents a lot of financial benefits, but they also, it materially changes the company's risk profile. The entire process coming up with an IPO is a quite volatile time for a company, and we have Nilesh here to give us more insights on this subject, and subsequently we'll be having all our speakers. Anup will take that over, and we have Ashok Mishra from General Atlantic and Harsh Bais from Trilegal. Sanula Khan from Wipro will also be joining us, but I'll leave that to later. Nilesh, I invite you to make your opening comments and give us more insights on this whole subject we're talking about today.
Thank you, Anuradha. Thank you, CII, for giving me this opportunity to talk about ESG, IPO, and independent directors. If we look at Indian history, almost all our peers have left us behind. We were equal to China in 1980. Today, they are 5 times bigger than us. Somewhere, we failed to encourage entrepreneurship. Entrepreneurship requires capital and it requires opportunities. Let me first come to the opportunities and then come to the capital. Today, we have one of the best opportunity for India to grow. China plus one is ensuring that global manufacturers move out of China to other countries. Every single country on the world is laying out red carpet for them. But most of those countries put together does not have as big domestic market as India. To give you an example, Samsung came to India long back. It is the largest consumer durable company in India. Being an unlisted company, we don't know their financials with precision, but it's roughly about $12 to $13 billion in turnover. They make in India to sell in India. They went to Vietnam much later. Their turnover in Vietnam is upwards of $60 billion. They contribute 28% to Vietnam's GDP. Now, this is our opportunity to create many such Samsungs, local company as well as global company, capturing this China plus one opportunity. More importantly, in order to strengthen this opportunity, we have taken out reforms over the last 30 years. And today, stars are aligned for a great foundation for growth to accelerate. We have migrated from high inflation economy to moderate inflation economy. We have migrated from shortage of FX to plentiful of FX. We have migrated from fiscal profligacy to fiscal prudent. And even though deficit numbers are high this year and last year, thanks to pandemic, we are far more prudent compared to many of our peers. We have moved from crony capitalism to meritocracy. We are moving from infrastructure shortages to infrastructure availability across many sectors. We are moving from physical infrastructure to physical and digital infrastructure. To give you a very small example, there was a reporter of a colonial magazine which was, staying in India for 3 years, could hardly find anything worthwhile in India. Then he was shifted to France. And the first tweet he made about India was, when I want to shift money in India from one bank account to another bank account, it was instant thanks to IMPS. The damn thing takes 3 days in France. This is the power of India's digital infrastructure. We are leapfrogging many of the developed nations. And finally, and the most important thing, is government accepting that they have no business to be in business. From giving commanding heights to public sector undertakings, we are now giving importance to public-private partnership. Now, all these things have created opportunity, but India was always about not converting potential to performance consistently. There were periods when we will do and give hope to optimists that now potential will be converted to performance, and then suddenly we will take the feet from the accelerator. But with this foundation, there is huge opportunity for India to accelerate. And in order to capture these opportunities, our entrepreneurs require capital. Right now, we are seeing initial public offerings coming in quick succession. However, about 68% of total IPO raised since April 20, they have been offered for sale. They are going to the existing investors rather than going into companies. And only about 32% is going into companies. Clearly, if we want to create $5 trillion economy, this kind of mobilization is not going to be sufficient. Fortunately for us, the mobilization in public market to some extent is compensated by mobilization in unlisted private market. A lot of venture capital, private equity funds are coming and funding entrepreneurs' ideas. And we have seen a rapid succession of unicorns being created thanks to that private investment. At the end of the day, whether it's public investment or private investment, whether it's listed investment or unlisted investment, you will require governance, you will require environmental and social consciousness. On the environmental side, jury is yet to come out clean. I recently read a report which said that Germany spent $580 billion in last 10 years to set up the renewable energy base. Despite that massive investment, their emissions haven't come down. And right now they are staring at energy crisis. And the only savior seems to be coal-driven thermal power plants. What is in our control is the governance. If we can improve governance, I'm sure we will be able to attract capital around the world. The market has already differentiated between governance, good governance versus bad governance. Time and again, badly governed companies are unable to access capital market. Their valuations have generally remained low, bearing a full-blown bull market. Whereas good governance companies are able to raise capital whenever they want. They're able to generally trade at a premium valuation to broad market. And clearly, good governance companies have created far more value for their investors, including promoters and minority shareholders. Fortunately, governance is not an alien concept. Tata's were torchbearer of governance for a long before ESG norms became famous. However, now we are seeing a momentum getting built for governance standards thanks to the intervention at law level. Regulators are also supporting good governance. Industry, corporate bodies also are coming and setting up good governance guidelines. And investors are also demanding good governance. Many a times before, the debate between investors and corporate board remained below the radar. It was not coming in public domain. It was more of a subtle activity. But recent incidences have shown that investors are now willing to take public battle. All these things are creating foundation where entrepreneurs with ideas will be able to get capital in public market as well as private market. They will be able to get funding in listed as well as unlisted market, and they will be able to command better valuation as long as they are following appropriate governance standards and displaying appropriate social and environmental consciousness. I believe India has a great opportunity today to capture and accelerate growth by capturing all these opportunities. And most importantly, there is capital available to the right entrepreneur if he is willing to walk on the path of environmental, social, and governance standards. I hope and pray that we don't lose this opportunity like many a times in the past. We convert our potential into performance and we move upwards of $2,000 per capita GDP bracket. We close or narrow gap with China in terms of GDP. And all these things is possible by developing our capital market, by providing right funding to right entrepreneurs, and by allocating our savings in a more efficient investment. I'm sure today's panel will discuss many of these aspects. I hope and pray that CII keeps on working on ESG norms, ESG principles, ESG standards across the industry, and it acts as a bridge between issuer and investor. With this, I will end my talk and hand it over to Anup Dhingra to take it forward.
Thank you, Nilesh. Your optimism, as usual, is contagious. And I really pray that, what you're saying comes true in our lifetime. And as they say, the risk and rewards also go hand in hand. Today, we have four very eminent personalities sharing their unique vantage points on how best managed companies emphasize good governance and how stakeholders, especially investors, value this thing. So we have with us Mr. Alok Mishra. He's the operating partner at General Atlantic. It's a global growth equity firm with $65 billion worth of assets under management globally. And they've been also a participant in the India growth journey for the last 2 decades. We have Harsh, who's a partner and co-head of corporate practice at Trilegal, which is a leading law firm in capital markets, M&As, strategic alliances, JVs, and helping clients go public. We have Jyoti Pawar. She's the Senior Vice President and Deputy General Counsel of Infosys, which, as you know, is a bellwether for Indian companies from a corporate governance point of view. And it recently entered the elite club of companies with a market capitalization of $100 billion plus. And last but not least, we have Mr. Sanaullah Khan. He's the company secretary for Wipro, which is another company known for its stellar governance and also very well known for running a very successful enterprise while keeping its management and ownership separate. So I'm privileged to share this floor with all of you. And let me start with Sana. Sana, why don't you tell us about Wipro's corporate governance journey, especially with promoters' ethos of keeping ownership separate from management? You're on mute, Sana.
Am I audible now?
Yes, sir.
Yeah, hi. Hi, thank you, Anup. Thank you, CIA, for giving me an opportunity to share some thoughts here. Nilesh has highlighted very well how important it is to have the highest standards of governance and how it will attract investment and how the valuation of the company improves with the standards of governance. So at Wipro, yes, we have been at the top of this highest governance standard, and globally, it's proven that high standards of governance attract investment at a low cost. And we are also listed on the New York Stock Exchange apart from the BSE and NSE. So we do comply with both the Indian regulations as well as the New York Stock Exchange regulations and the SEC regulations from a corporate governance standpoint. But at Wipro, to be honest, more than the regulatory requirements, a lot of things that we do and are mostly voluntary in nature. We do things when even though they're not regulated. And like for example, if you look at our board composition itself, if the board is required to be composed with 50% of independent directors, we have much more than that number. We're close to 70%. Um, a large part of Wipro's shareholding is also with the philanthropy, and that actually makes it more important for us to kind of maintain high standards of governance. And every rupee of profit that we earn, about 60 to 70% of that goes into philanthropy. So we take pride in that. The tone at the top is very clear to maintain highest standards of governance and ethics. There's absolutely no compromise there, be it the promoter or the board. A lot of things that we do voluntarily, even though the regulations don't require us to do. Corporates must deliver this message that integrity and ethical values cannot be compromised, and customers, associates, and employees must receive and understand the same message. And it's very clear at Wipro that we demonstrate this through our words and actions, and we are committed to very high values of ethical standards. At Wipro, if you look at, if I have to talk a little bit about the journey of corporate governance, it's not a one-time action, or it's not something that we do today and we don't do tomorrow. I think it's a continuous process. Wipro has evolved over a period of time. It's a pre-independence existing company. So 1945 is when the company was incorporated, and the public issue of the company happened in the year 1946. So it's like a journey from there, and how we evolved, how we maintained higher standards of governance, how we maintained our brand. I think the promoter has put in a lot of effort here, and like I said earlier, the tone at the top is very clear. Wipro is one of the first companies to set up an audit committee in the year 1986. And even the composition of the audit committee today is 100% independent directors. It's not just 50% like the requirement as per the SEBI regulation sees. Wipro has also won the Alexander Hamilton Gold Award for Excellence in Investor Relations way back in the year 1998. In the year 2000, we have set up a US GAAP audit. Then we have also won an international award for institution from Institute of Auditors in the USA. So there's a lot of things that happened, and recently Wipro has been awarded from the year 2012 onwards the world's most ethical company, which is an yearly award, and this is one now for the last 9 years. So it's a journey, and the governance standards are very high. For someone who's working here for the last 4, 5, 6 years, I can understand and tell you that uh, it's not just lip service, and there's a lot goes into this in terms of the thought process, and then in terms of how we react to situations, how we make our disclosures for the investors. So a lot of things are going well for Wipro. Well, your question on ownership separate from the management, that's always been the case here. There is a professional CEO who runs the organization. The management team is built around him, who's responsible for the day-to-day operations of the company. The ownership is kept separate, and there's an arm's length maintained at the same time. Board level supervision is also there, where we have well defined or well-respected board members. Out of 9 directors, 6 are independent today, with 2 women directors. So I think it's a well-governed company. And I'll take a pause, Anup here.
No, absolutely. That does help us with the secret sauce. And my next question to you, Jyoti, is tell us about Infosys's corporate governance approach. I know your founding fathers have always believed that when in doubt, disclose. But is there more that makes Infosys a beacon of good governance, like Sana said?
Thanks, Anup. Yes, definitely. I think Infosys founders laid a very strong foundation of corporate governance, and over the years, the leadership that joined then built on it, and it's a continuous process. So, I mean, I think governance is about maximizing, the shareholder value legally, ethically, and sustainably. So, sustainably is the key word over here, right? That you have to build on something and sustain something. So various things really go into maintaining that, and what your framework is the most important things, and I'll touched on that also. So for us, I think we have our framework is built around values, which is values of sea life, as we call them, which is effectively client value, leadership by example, integrity, transparency, excellence, and fairness. So that's what our overall principle or the guiding force is, and all our governance is revolving around these. Um, uh, we have won, I think, very recently in the past year. I'm just talking about the recent awards, many awards around corporate governance per se. We've won one, I think, even the latest one from Etisphere recently on this. So, like you started by saying that both companies are recognized for their governance, and rightly so. So apart from, what our ethos or beliefs are, I think what is very important for a good corporate governance is a very good board composition. And we do take great pride in the board composition that we have. Everyone's aware we have a very diverse board, very, very good, eminent personalities, well-respected, credible board partners from different walks of life. There is diversity in culture, there's diversity in industry, geography, ethnicity. I think it's all there. What and how we do it in a very, very little snapshot, so that I give opportunity to all the others also to speak, is basically at the top you have the board, which has various committees under it. So you have the compliance, you have audit, you have risk, and the usual that various committees are there. But I think what really stands out over and above that is the subcommittees that are then formed within the company to make sure that each of the mandates that the board gives you is then followed through, and a process or a map or a progress sheet is sort of put into place, and everything is monitored at the top management level. So it's not that the board meeting comes up and there's a buzz around it. I think there's a buzz through the year. There's so much of a buzz that we have this habit of self-audit, right? So the legal department itself, my own department, has audits on our own self. We've got a special audit team within the legal team which audits things that we believe will come up in the future and as risks. So we make sure that we've got all of that in place. We have a disclosure committee, which is at the top again, where different CEOs of different businesses across different countries are expected to disclose what they believe could be issues. And so that's a very fair opportunity given to everybody to come forth and talk about whatever the issues are, so that we can solve them. And if there's anything that is material, then it's further taken up to the board. Additionally, I think the last point really is going to be on subsidiary governance, given that we have so many subsidiaries and so many companies that you're probably listening in or otherwise are always, dealing with subsidiaries also. So we have a very strong subsidiary governance process that we've revamped, and we look at revamping almost every year, all the processes, but this one in specific this year, because there have been a fair amount of acquisitions, etc., and we believe that that is important. So we've made sure that we have understood the differences in the businesses of the subsidiaries versus us, and not sort of done a blanket copy everything Infosys does, because that's not practical. But how do we then safeguard with certain non-negotiables for the subsidiaries so that they definitely follow the basic guidelines? I think that's how, I think in a snapshot, we are managing our subsidiary governance as well as our corporate.
That's pretty useful. And Jyoti, I totally can agree with you. Always buzz when I come and visit you.
Yes.
So, Alok, let me ask you this follow-on question. I've known you as a CFO for some of the most progressive firms in India, and now as a large investing partner. What do you look for while investing? And does governance or quality of management play a part in your investment decisions?
In fact, it's the most important part of the investment decision, because fundamentally GA globally and definitely in India as well is a growth equity investor. So we take minority positions. We are not majority or control investors. We're not buyout, late stage, leverage kind of investors. Our ethos is fundamentally as a minority growth stage investor. And we may have I would say, at best, a dozen companies around the world. We have about 165, 170 portfolio companies around the world. Maybe at best, a dozen would be control investments because of certain historical reasons. I think we have only one in India, and rest of them are all minority growth investments. So for us, fundamentally, we are backing a founder or a founding team or a management team. So for us, that becomes the most important. Secondly, we are not there inside the company, nor do we put our people there to run it. So for us, the company has to have the highest quality of governance for it to be to make sense to all stakeholders, including us. So in protecting our investment, enhancing our investment, making sure the right management decisions are made. And that governance obviously starts with having the right board. So in many cases, you will find that investors want veto rights or affirmative vote rights and those kind of things. We took a slightly different approach right from the beginning. And when I say beginning, this particular team has been together since 2013. And we kind of rebuilt the team in early 2013. I joined the firm around middle of that year, where we took an approach that we will try and use governance as a means of uh, protecting investor rights and all stakeholder rights. So look at all stakeholders equally, not just give one investor a veto. You may have certain rights which are more governance related or to protect your investment, protective rights. But by and large, we said let the board run the company, let the board decide and take the decisions and constitute the board. So even in fact, the second investment we made was a IT company in 2014. It was a private limited company. It did not need independent directors, yet we had independent directors on the board. And we constituted the committees. We had an audit committee, we had a finance committee, we had the CSR committee, and we ran, we had NRC also, and we ran the company as if it were a public company with independent directors, even though it wasn't required. So we've used actually governance as a means of shareholder value enhancement and made sure that we have the right man. And there's a right management team that we back. Now, we usually would look to help that management team build and supplement in terms of additional roles and things like that. Very often, one of the first things we are required to do is help the company recruit a CFO or a company secretariat, because those are one finds in early stage companies. Probably some of the neglected roles. Everybody is very more focused on the technology or the marketing or the sales part of it. Sometimes finance, legal, and all uh, you know play a secondary role. But when we come in, we try and enhance that and make sure that they have a seat at the board, and they are given the due prominence, because that is the best way of protecting everybody's interest. Having the right statutory auditors, bringing in an internal audit requirement, even though it may not be required by law. We enforce upon people, or we impress upon them rather, that what is the benefit of having good internal systems, processes, controls, audits, all of that. And that's been really, really beneficial for us across the board. And we found that in general, the company processes have improved. And ultimately, when the company grows, it has to grow with discipline. So there has to be the infrastructure. Otherwise, some of that growth may not be sustainable. So we impress upon the founders or the promoters that it is important to have all these processes in place so that the growth is in a disciplined manner and it is sustainable. So everybody is pretty much, what we found is that once you explain the logic, it's usually accepted. Equally, bringing in the right diversity, bringing in the right mix of people, both in management as well as on the board, not just the board, but also in the management, having the right leaders with the diversity, religious, ethnic, gender, all of that. And that we found always has added value and ultimately leads to a better value for the investor as well. And it's all about building the company, helping it grow, and with the ultimate objective of saying, you're able to take that company public.
Makes sense, Alok. And I do remember that 2014 example that you were mentioning. So, Harsh, my next question to you is that while institutional investors value this thing, like we heard from Alok, how about your advice to clients which are looking to go public? Is good governance, including disclosure mechanisms, a luxury or a necessity? And what are those minimum set of things that you would encourage your clients to adopt? You're mute, Harsh.
Anup, thanks for setting the stage. It's a pleasure to be contributing to this discussion. Like you, we can't take credit for our clients' businesses because they have built them. But we do have a role in providing advice and assistance. And in a sense, when we do that, just like yourself, we also advise our clients on risk and what their approach should be to risk, in particular legal and regulatory risk, but other things. As Mr. Nilesh Shah said, there is a unique alignment of opportunity, capability, and capital at this time. And we have the benefit of helping our clients navigate the opportunities that they see and make the choices that they make in this environment. So whether it's a public offer, like you just mentioned, or it's an acquisition, or it's some other kind of transaction, increasingly, and it has been so for a while, the clients we work with have become increasingly focused in this, and they have been, many of them, for, as was mentioned earlier on the call, for many years, in some cases decades. I think what has gradually now become the consensus view is that strong governance and ESG standards also contribute, as Alok just said, to valuations. So the advice that we give our clients is, and I won't get into the details, there are many aspects of different kinds of transactions which are, for which different things are relevant. But the bottom line is, have you set up the systems in place whereby governance is not the exception, but it is the norm? In other words, it should not require active or positive action to ensure governance, although governance is something to pay attention to continuously. But partly the advice that we give is that you cannot simply rely on those positive actions taking place all the time, although you should take those actions, but you need to have systems and governance policies in place where that gets attention. And the independent directors, compliance policies, all of these contribute to that. And to sum up, as someone has said, sunlight is the best disinfectant. And the hallmark which both internal governance mechanisms look to achieve, as well as external advice is geared to advice, is that the way any business goes about its activities or its investments is such, it should be such that if everything was known and disclosed to everyone, it would be fully justifiable. And that is the advantage of having, whether it's internal audits or independent directors or other such mechanisms, because these are all different gatekeepers who ensure that choices and decisions have to be justifiable and they have to be justified. And that is an important aspect of governance. So I think without getting into aspects that are peculiar to various kinds of matters, I would say that's probably those are the two hallmarks. Number one, do you have systems in place which promote compliance and do not require active intervention just to secure compliance? And number two, are those systems ensuring that all decisions are actually fully justifiable, assuming they were fully known to the whole world?
I agree, Harsha. And unfortunately, in the real world, justifiable in hindsight. So, totally get it. Huh? Totally get it. Sana sir, my next question to you. Your firm has really accelerated both organic and inorganic growth in the last few quarters. So many congratulations on that. How do you view retention of management, which you mentioned is key, board diversity, company culture while integrating? I think Jyoti also touched upon that thing. And in words of what Jyoti was saying, what are those minimum no compromise items that you prescribe? And what are the things that you can live with, while respecting company culture?
Yeah. So Anup, last few quarters have been good for us, but we are too close to the quarter end. I think I may not be able to comment much. We're in a silent period. But yes, last few quarters have been good, and of course, we have still a lot to catch up. As you know, there was a CEO change that has happened a year back, and also a strategy has changed. And when the CEO change happens, a lot of leadership roles also keep changing. There will be new leaders who will be emerging, new leaders who will be hired from the market, etc. But one thing that hasn't changed is the value system, and Thierry, who's our CEO, has been very, very clear and vocal about it, that Wipro is known for its governance standards. Wipro is known for its value system. And so that remains constant, and probably we'll have to see if we can take it to the next level, if at all we need to take it. There's absolutely no compromise on that in terms of the values and ethics and governance standards of the company. One other interesting thing that has happened in the last about year and a half is that our chairman now, Mr. Rishad Premji, he has taken up this task of uh, uh, talking about the 5 habits he would like to see in every Wiproite. When I say 5 habits, he has actually articulated and came out with 5 simple habits that every Wiproite need to have. Uh, Being respectful is number one. That is how you treat others within and outside of the organization. Being responsive, how do you react to a situation, and how do you take care of a situation or your own team members, your own customers, your associates, everyone. Always communicating. Surprise is the last thing that we would like to see. Demonstrating stewardship or the ownership, that's the fourth one, and building trust. So these 5 habits, he has personally met over 17,000 employees during the last financial years. He has done about 75 plus sessions, and to talk about this and how important it is for the organization to kind of inculcate these 5 habits within every Wiproite. So there's a lot that has happened. There's a lot that has gone into this process of building a sort of environment or a culture. The culture is nothing but its employees, and pandemic has only made it tougher for all of us. You also know, and we have all seen that. But this continuous communication and talking about these 5 habits and tone at the top has really helped us. The other point you raised is on board diversity. I think we have a very clearly articulated policy on board diversity. No discrimination on color, race, and nationality or gender. And if you look at our board today, we have about 9 directors. Out of them, 3 are US nationals, and one, our CEO, is from Europe, and we also have 2 women directors. So I think it's well represented. It's the great amount of diversity, geo representation, at the same time expertise. We have very clearly articulated policy on who should be on the board, what is the skill sets that are required to be on the board, whether we are ticking all those boxes when we are appointing new board members, It's not just business, it's just not just audit and accounting experience, or it kind of the entire skill set and has been defined by the Norm and Rem committee. And Norm and Rem committee from time to time looks at candidates and profiles while appointing, and what is that's missing in a board. So a lot goes into that, a lot of thought process goes into that, and Rishad and Mr. Premji, they drive this very clearly. At the same time, we also have an independent Norm and Rem committee which takes care of the board diversity. I hope I covered your question. If there is anything.
No, absolutely, Sana sir. And Jyoti, I just wanted to ask you a follow-on question. Like Sana sir mentioned, employees are the key. So between Infosys and Wipro, you probably employ 500 million people. Huh? And can you share some best practices on managing employment-related issues, especially with employee retention across various sectors? You're on mute, Jyoti.
Such a classic uh, example.
Every time someone gives me $1 for saying you're on mute, I would have been a millionaire thus far. Huh?
Yeah, I know. No, so Anup, I mean, to your point on retention, if I take a step back on attrition, it's like for the tech companies, it's really unreal what's happening. And in the legal department, I mean, we believe we lose our lawyers to law firms, and the law firms believe they lose it to corporates. So I'm not so sure. I think they're all joining insurance, right? You can comment on that. But that aside, if I look at retention, so I mean, I think one of the things that really strikes me at Infosys is the sheer flexibility that we offer our employees. Right, 9 days work from home, irrespective. This is before COVID, also, right? It's very easy for employees to work at Infosys. It's very flexible hours, etc. It doesn't matter. I mean, wherever you are, as long as you deliver. I think that's very important as a retention strategy. Our entire employee framework is built on say connect. How do we connect with our employees? What is our communication? And that's a constant thing. How do we collaborate with them? How do we celebrate with them? How do we care for our employees? What is the culture? Is it of respect? Is it no tolerance to integrity or compliance issues? So I think all of this creates a certain culture, and all of this on a campus, which I take great pride in, being a part of, which has got every facility that you can think of, state of the art, sports, medical, I mean, you name it, it's there. And irrespective of COVID, I think we had the culture of celebrating concerts. We had the Infoscian Petit Day, which is for children. About 16,000 children participated, right? So we had, different concerts, different whatever talent the kids had, and it was all there on a particular day. All of this, I think, does really help employees to belong and feel that they are a part of this Infosys community. I think, all of this aside, I think this is almost like a hygiene factor, which Infosys offers, and, you join. But at the end of the day, the employee wants to also understand the career path, right? So I think there are 2 or 3 key things. One is, do I understand as an employee, what is the next step for me? What is growth? What does growth mean for me? So when the company says navigate your next, what is my navigation? What's my navigate next, in my personal career? And how do I go about this path? That's the other one. And then, of course, the third one is, how do I then compare, my contributions versus my remuneration and the market? So it's a combination of all of this. And I think having recognized all of this, it was recently covered also in the media that we have looked at revamping and benchmarking various segments of employees to see what is it and where do we stand. Special bonus incentives have been given very recently for high performers. We've also raised the bar in terms of remuneration for the others. We are looking at a very formal, or rather it's ongoing, a very formal mentoring process where a very senior mentor is assigned, helps you understand the company better, helps you understand your prospects better. There are courses in Stanford or in various other universities where employees can reskill, upskill. I think these are all very important aspects. And the most important, Anup, I'll just end with this one is I think trust. Some sort of a continuous transparency, communication. If there's something covered in the newspaper, whether it's in India or any other part of the world, it's important that employees are immediately told that here's where we are on that particular aspect, right? So very clear communication on growth, on issues. is important. We also have the Anti-Sexual Harassment Committee, which is, I think, very, very essential, a compliance committee, a complaints committee. And we have something called the HALE, which is Health Assessment Lifestyle Enrichment, which takes care of mental issues or emotional stability issues, and a lot of it really helped during COVID time, right? That these things are very important. I think all of this put together, helping employees transform their skills while the company goes through this entire digital transformation. I think these are very important retention strategies, which we have, some which we already have and some which we have now implemented in the very recent past.
Understood. And every time you let me stay on your campus, my first preference is to stay on your campus. I really, really like it over there. Alok, over to you. You have investments in so many digital economy firms. Do all of them have to make money on day one? And how patient are you if the company and its management is fundamentally good? Are there any specific skill sets you're looking at, or a mix you're looking at while crystallizing management structures? Even though, like you mentioned, you have minority investments.
So just to give you an example of how patient our money can be, we invested in the National Stock Exchange in 2007 March. We exited last year in December. So 13 and a half years, I think there'll be very few financial investors or private equity investors who've been invested for that long. Our structure is such that we don't have classical funds, and therefore we don't have the classical end of fund life issues. So our money is relatively evergreen. No money is evergreen, right? Every investor wants a return. They want their money back at some point. But I guess our money is, our investments can be a lot more long term, right? So a lot of our investments in India have been, we've been invested in one of the analytics companies here in Bangalore. We've been invested now for almost 11 years. So 10 and a half years that we've been invested there. So it really depends. I mean, we are in it for the long term, and it depends on how long the company needs. Does the company need to make profit on day one? Not necessarily, as long as there is a good visibility to profit. What we look for is really good unit economics. That means at the margin or at a contribution level, are you making money? And then you may be reinvesting some of that in, let's say, IPL advertisements, like a couple of our portfolio companies do, or some other form of investment in building infrastructure, building your, expanding your sales network, growing your sales footprint across different geographies. You're reinvesting that for the future and for the growth. That is absolutely fine. What we would look for is fundamental unit economics. As long as that is sound, then the rest is easily manageable. So some of the investments we made, I remember one of our investments was recently in the news because we've signed an agreement for the exit. When we invested in 2015, it was highly profitable even then. It continues to be as profitable, if not more, today, and it has grown, several fold from the time we invested. So it's not really about being profitable on day one, as long as the unit economics are sound and as long as the investments are made in a sensible and controlled manner. At some point in time, they will all be, they should all be profitable, barring, some unforeseen. There've been delays. For example, we have a women's wear, women's fashion company. When we invested in 2013, for the next couple of years, it grew fantastically. It was making huge profits. But for the last year and a half, I mean, till about July, from around, I would say, March, April last year till July, it went through a really tough time, except briefly in Jan, Feb. In between the two waves, it kind of recovered a little bit, then again got hit by the second wave. So retail in general got very badly hit. We have a restaurant company, they got badly hit. But all of them have sound unit economics. So the moment normalcy, whatever that form, whatever form it may take, I've heard the new normal, like you've said, you're on mute so many times. I've heard the new normal so many times. I would also be a millionaire if I got $1 for each time. So no one knows what that is, but whatever it may be, all of these guys, if you have your fundamentals in place, it's all it'll all work out in the long term. And like I said, we're all long-term investors. The on your point on skills and things, it's really about fit for purpose. The way we look at it, there's no need to take a cannon to shoot a fly. So you want to have a solution that uh, is of the right size and the right, I would say, makeup for what the problem is at hand. It is not that very often, when we're looking for a CFO of a company maybe, 120 million dollars of top line, and they want somebody who's already done a IPO. I say, if the person has already done an IPO, why would they come and join you, right? So you have to find somebody who may have been, part of the IPO team, but now has an opportunity of proving his or her own worth and doing all of that. So that's how you look for a lot of the diversity in the team, people of diverse backgrounds, experience, different industries. So initially we used to always think that as long as the person is from the same industry, it's a huge advantage. But that's not always the case, right? It depends a lot on the individual. People who may come from a different industry altogether may still do a great job because some fundamental principles are the same across industries, and it also depends on that individual's enthusiasm, the individual's energy level, and the ability to roll up their sleeves and get to work. So on the profit question, like I said, it's not that they will be profitable on day one. They just have to have we just have some kind of a plan or a visibility that they will become profitable, and the building blocks of that profitability have to be there, which is really what I was talking about, the unit economics.
And like you said, people are the key. So my next question is actually to Harsh. On the people side, are the regulations related to
I
independent
think Harsh
directors?
lost his
Are,
connection, maybe.
Harsh, oh, we lost Harsh.
Yeah,
So
we've
Alok,
lost. I saw his video froze and then he dropped. So maybe he had a.
yeah. So Alok, let's do one thing. While we get Harsh back, let me ask you another question. We're all aware
Sure.
of all of your patient money as well as your string of successful investments. Tell us
I knew this was
something
coming.
about your failure. Tell us
I
something about your
spoke too much
failures.
too soon.
No. But tell us something about failures also, especially some key takeaways and learnings that you would
Yeah,
like to
we've
share with
made
our audience.
we've made what, close to 20 investments in India over the last 20 years. Harsh is back. You want me to go ahead, or you want to?
No, go ahead, Alok. Huh? Let's
Yeah.
hear from you.
So yeah, we've actually we've had a couple of issues, and I think one of the things. So maybe I'll relate a little anecdote, and that'll help relate. About 2 years into my, as you know, I don't come from a PE background. I was an operating CFO of, Indian listed company, US listed company. This job dropped into my lap. I became a PE guy by accident and by destiny, I suppose. And about 2 years into my job here, one of the big four partners who does a lot of diligence work for us asked me, so, Alok, what have you learned in your 2 years? So I said, I've learned two things for sure in 2 years. Number one, PE guys don't know how to run companies. So we should stay out of people's hair, get the right people, help them, and let them run the company. We shouldn't be getting into the company and running it for them, because most of us, I may be a slight exception, but most people are astute investors, may not be necessarily the best operators. That is the first one. The second learning I said was, we have a great legal system, we have rule of law, we have all of that. But end of the day, as a minority investor, and this is why I realize why a lot of people choose to be control or majority investors. As a minority investor, it really boils down to partner selection. How do you choose who you're going to partner with and who you're going to invest in? So, which is relates me back to the first question that you asked. That is why that management team becomes really, really critical. And the only time, and I would say in our history, we probably had one and a half kind of misses. And in both instances, it was really about not choosing the right person, not having the right, I would say, checks and balances and controls, or the right governance, just trusting the person. And in one case, they really let all. There were two investors sitting there. There was a big fraud inside the company. They had siphoned out funds and all of that. And by the time, and this thing blew within about a month of my joining. So most of it had already happened, and then we were trying to clean it up. We're still in litigation with that company. The company is, the last I checked with counsel, they were kind of into the liquidation process, but that is also stalled for the last year and a half because there's no because of COVID. But the lesson learned there is really be don't get seduced just by the spreadsheet models and all of that. End of the day, you're investing behind people. Especially as a minority investor, you have to be very, very clear and careful who you partner with, who do you invest behind, and how do you manage the governance so that you keep a track. So, for example, in this company, we had statutory audit, we had a big four auditor. In fact, they are the ones who discovered the problem in the first place. But that was a once a year kind of event. There was no real internal audit kind of process. There weren't regular reviews and things that we were doing. So we trusted that person. The business was seemingly doing very well. But end of the day, you figured that there was a lot of fraud going on in there, and they were all cooked numbers that were being published. So I think that's why thereafter, almost every company, we have a good internal audit process. And we also make sure that we do a good diligence, not just on the company and its financials and the legal and the statutory aspects, but also on the people that we're going to back. So we talk to other people they have worked with. We talk to other investors they may have worked with to see were they, good partners in business. And we do a lot of that diligence at a personal level before we invest. And equally, I'm sure they do the diligence on us to say, are these guys good investors? So
I totally get it. I totally get it, Alok. And you're right. I think people make it or break it. So, Sarasa, let me ask you this thing, huh? On the people side, sometimes people do get disillusioned also, huh? So what happens if there's employment litigation, frivolous or otherwise? What's your approach? And do you feel there are some geographies which are hotspots for these kind of, items? And other thing is, in your experience, does insurance play any kind of, role in any of these financial reimbursements or anything else?
Yeah, sure. So litigation has become the new normal, if I have to use that word again, like Alok is saying. Especially the bigger you are, probably the more will be you will be targeted, both from external as well as internal stakeholders. But having said that, yes, I think what's important is that I'll take a step back. I think if your hiring process, it all starts with the hiring process. If you're hiring the right people who fit into your thought process, who fit into your value system, who fit into your culture, the organization culture, and when you also look at these 5 habits that we are talking about, I think if you have a more streamlined process of hiring and you're choosing your employees well, who fit into your organization culture, it's that much easier for you to kind of manage those employees and their expectations. So even our talent review processes today, where we talk about high performance culture, it's not just about whether you're meeting your targets, whether you are able to deliver your KPIs or KRAs, whatever you call them. It's beyond that. It's like how you are also inculcating those 5 habits. You will also be rated on those 5 habits on your quarterly appraisals in terms of whether you are living up to those 5 habits the organization wants to see in you. Are you leading a team with those 5 habits? So I think there is a lot more thought process that has gone into it, which I'm sure is helping us. But having said that, yes, there is litigation, there is employee litigation, there is vendor litigation, there is client litigation. That's always there, and insurance does protect us from all of these litigations. I think what's also important is that how we are present in Wipro is present in 50 plus countries. So are you complying with the law of the land? The law of the land is different, and there is absolutely no compromise there. and whether your employment policies are fair and reasonable, and whether are they questionable. How are the regulators looking at you? How are the regulators looking at your immigration policies? There's a lot of exercise needs to be done, and we are there, and Wipro being present for more than 75 years, we know our trade, and we know where the bottlenecks are, where the risks are, and we are trying to minimize those and trying to do our best. Frivolous litigation again is a major problem. I'm sure Jyoti can talk more about it, and the problem is that how do you handle it, and whether you will give in, whether you will settle, or you will, because the litigation costs are quite high in some of the geographies, particularly in the US. If you go to a California state, if you look at a wage and hour litigation, how expensive it is, So whether you will fight out, knowing that it's a frivolous litigation, whether you would like to fight it out or whether you would like to settle the matter, what will be the repercussions of settling that matter, all these things, they differ from case to case, I would say. But experience comes handy. We get the counsel of external counsels like trilegal, etc., and particularly from the other geographies before we take a final decision in terms of how do we go about it. Insurance does play a large role. It's not a. I would say it is more of something where the insurer also comes and shares some of his experiences when it is a large litigation, some of his experiences, and Marsh pitches in, and Marsh tells us as to whether how do we go about it, who's the right lawyer, etc. in those geographies when we are facing some of these litigations. Insurers do play a role there, but at the same time, we as an organization always behave as like a prudent uninsured rather than an insured, where it will help us take the right decision and the right call. Just because there is an insurance, you don't go and settle a matter and try and claim the insurance. That's not the approach we have. The other thing that we also do is proactively, insurers don't like surprises. So we keep the insurers informed in terms of whenever there is an event happening, even before it turns into a litigation. So how do you manage your litigation at various stages, and how do you keep your insurers, your external counsels involved? All of that does play a role.
Appreciate that, Sana sir. So you're right on cue, huh? Jyoti, I think apart from people, and I know you do a lot to keep people happy, there's a lot of significant uptake in shareholder and regulatory activism also. So do directors bother about insurance or any of these things? Are they happy with company indemnification? Do you think a good directors and insurance program is helpful in attracting and retailing board talent and diversity? And if yes, what do directors look specifically from all of these things?
So I think shareholder activism, as a term, I think it's rising globally, probably more outside, and maybe some early signs noticed in India also. India today is at a stage where we do have an opportunity to learn from best practices of other countries, right? Having seen a lot of this happening everywhere. And the important thing, like most of us have spoken today, is, important to continue having that corporate governance, and insurance does not make up for it. And Anup, you know how difficult it is to get the money back from insurers also. So that aside, coming back to your question on, whether directors are happy with what is there already, or are they asking for more, etc. I think there is always a mix, given that in any global company or any multinational where there is a mix of subsidiaries, etc., there are some directors who are happy with the coverage that the parent has. There are some who are not happy and want an additional coverage. There are some directors on the board who will probably be happy with what is there, and the others may ask to do a full exercise to see, and different things determine this, right? It's how the market is, how the environment is, what kind of claims have happened in the market, in the industry, or and some advice from you yourself, your brokers, insurances. I think all of this drives the decision on whether a director wants us to increase the coverage or to maintain the coverage. I think various factors go into it. But your question on whether are they happy? I think one of the things that you want to know. I think D&O insurance is extremely important. Every director, especially after the Change in Companies Act, various regulatory, pressures that have been put on independent directors or directors, even for that matter, management of a company, it becomes imperative on the person for their own personal and professional protection to definitely have a D&O insurance and to sort of join a company which has a solid D&O program. So I don't know if that answers all your questions, but yes, I think it is important to have it. It's important to read, for a director to ask for a copy of it before they accept the independent directorship, to read and see whether they have protection, to see if they have protection after they retire from that position of director, because all of this is important, right? Eventually, litigations are not easy and to deal with, and the D&O insurance also protects the fee, the litigation fee also. So putting all this together, it's important, and it's something a director should give a lot of weightage to and read through. But having said that, it doesn't compensate for a strong governance mechanism. Yeah. And you were asking me whether, sorry, just last thing I remember that you also asked me whether it pulls people, in terms of, yeah, so it does. I mean, when I was looking at considering Infosys, I think the fact that Infosys has such a great reputation made a big difference. But anyone's instant reaction, like mine, was also to go and see who's on the board, and having people like who we have on the board makes a big difference, right? And who's on the management, who's the management committee, where have they come from, what is the reputation that they have? I think all of that makes a difference, and it does pull in good people if you have your credibility intact and your governance, and the faith of the stakeholders intact. Yeah.
But I totally get it, huh? It doesn't make up for good governance, huh? It's a safety net.
Yes, it's a safety net. It's an important to have. I would say it's more than just a safety net. It's important to have. But why go down that path? I mean, if you can just keep your governance intact, you can't stop. Look, it's a safety net because you can't. While you can have great governances, you can't stop somebody else from claiming that they're not good or litigating against something. So keeping all that in mind, I think it's important. Yeah.
Of course, no, really appreciate. And Harsh, my last question to you is that apart from these very large, very well-recognized, large listed companies, what is your suggestion when firms are looking to go public on disclosures or some form of IPO or D&O insurance, coverage for shareholders, selling shareholders, coverage for book builders? Any last piece of advice for our audience today?
Mute.
Harsh on mute, huh? I get $1 more.
Yeah, okay, there you go. Apologies, I had a glitch in my signal earlier. Let me speak to this in a little more general level. To be honest, I'm not an IPO lawyer, so I don't want to be shooting off my mouth on the IPO process. But let me comment from the perspective of governance, which is of course something that's common to all kinds of companies at all stages of their life cycle. And secondly, on the M&A context, where I think insurance is increasingly playing a role. I think enough has been, I said on the D&O side, so I won't repeat, but all of that was pretty important. I think insurance sort of goes hand in hand with risk. And whether it's legal services or it's insurance, it's really about managing risk, because sometimes the pain is in the process and not necessarily, it's not necessarily the outcome alone that provides solace to people, it's the process. And at the end of the day, it's getting another check of sense. And for instance, in the M&A context, when you get warranty insurance, it's getting up. It besides the fact that the insurer is putting money behind the product, it's also another set of eyes and another check on the risks associated with what you're doing. And I think that is also valuable to have. So But because, of course, due diligence is important. And I think much has been said on, partnering with the right people and having the right business. And those are, of course, central. But it also is comforting to know someone is putting more money behind this besides the primary party, right? And that's where the insurer comes in. So from that perspective as well, I would say, insurance is an enabler. I think it will increase even for smaller companies who undergo change of control transactions or who have directors and officers. Any company, governance is important for any company, and risk is common to all companies. So my advice to, I guess, any company at any stage is that obviously you may not be in the same position as a large listed company, but you could be one day. Or you may have investors who are also exposed to large listed companies and have similar standards. Or it's about risk. How do you set yourself up so you're avoiding risks which you really should not be taking. So I think that's where I would leave this.
Thank you, Harsh. And I'm just conscious of the time. It's 5:15, close to 5:15. So Anuradha ji, any thoughts from your side before we open the floor for question and answers?
Oh, thank you, Anup. I think it was very interesting discussion. I've taken quite a few notes. It's really interesting to see how ESG as a concept is coming up, apart from the financial figures and statements and documents that investors have been traditionally looking at. Now, globally, ESG has come out as an important parameter to look at for investors. So the discussion has been nice. We can take questions now, Anup, from the floor.
Absolutely. I would encourage our audience to use the chat function actively. If there are any questions, please do raise your hand. We'll be happy to unmute lines. Okay, no questions thus far. And I'm conscious this event is also being live streamed. I was told to share on behalf of the speakers that these are all their personal opinions, not their company opinions. So I'm sharing that. But you have our coordinates. If there are no questions right now live, we're happy to take some of these things offline. Please do email us. Use the CII platform as well. Good. So I don't think so that we are getting any more queries right now, but I think we've covered a very vast array of things, right from China +1 and the stars aligning together for our century. All goes well, amen. And second is that what do investors look at? What is the secret sauce for some of the best managed companies in the country, as well as what to look for when you're out, from an ESG perspective, from a disclosure perspective, raising of funds perspective, and when things go wrong, there's a safety net. And I look at this thing not just as a safety net as insurance, but more like brakes in a car. Huh? The brakes in the car make you go faster, not slower. So with that, it's a wrap, and really appreciate. Thank you, Anuradha ji, for this platform. Thank you, Sana sir. Thank you, Jyoti. Thank you, Alok, for your time, and really appreciate.
Thank you.
Thanks, Marsh, and to CII as well for having us. Thank you.
Thank you.
Thank you so much.